Trend analysis is made very simple with candlestick signals and the T-line. We could see, obviously, a few weeks ago when the close below the T-line told us that the Dow is now in a downtrend. Again, the magnitude of the downtrend was not known, but at least it put us in the right positions at the right time. We saw the bounce, the reversal signal, a morning star signal well in the oversold area after gapping down in the oversold area. The T-line rule, the further away you move from the T-line, the higher the probability it's going to come back up and test it. An uptrend is in progress when you see a buy signal and a close above the T-line. That's what occurred on whatever today was, on Wednesday. But we can see the nature of the market. It opened lower and traded lower. So it didn't confirm. And now we're back to the T-line rule that we're in a downtrend as long as we're closing below the T-line. This still tells us that there's indecision between the bulls and the bears. You had an up day, a down day, an up day, a down day. Remember what a doji represents. Indecision between the bulls and the bears. That indecision usually equates to a major change of investor sentiment. In this case, the bounce might be over, and we could be heading for a bearish J-hook pattern, meaning the probabilities, as long as we're below the T-line, investor sentiment is still bearish just because of the T-line, making a likely target down here or possibly another magnitude move of this. That same scenario can be applied to the Nasdaq. Even more so, look where the Nasdaq traded positive today, right to the T-line. Now that's a relevant analysis because nobody has the T-line on their charts. They have the 200-day simple moving average. They have the 50-day simple moving average. But they don't have the T-line. This is just more evidence that when it comes up and uses that as a resistance level, that is a Fibonacci characteristic, a natural support and resistance level that is illustrated by the T-line. Then we use the T-line rule. As long as we can't close back up above the T-line, we have to assume the downtrend is in progress. The use of candlestick charts is like reverse engineering of analysis. When the cruise line stocks were trading below the T-line and started to drop off. And then today, after a doji type day, they gapped down, making this a relevant pattern, a wave one, a wave two, now another move to the downside. Now that's not hard to evaluate because everybody knows with the China virus out there, the cruise lines are getting a lot of publicity about how bad things are on their ships, and that's why the investor sentiment has a much higher probability of not being positive right now, but being negative, and we can see that more clearly in the type of investor patterns that are setting up. You can still be short, or if you covered your short positions in this area, now you can reshort with the expectation that wave three could take you down much further. The same scenario can be applied to the Norwegian cruise lines, NCH or NCLH. Again, failing at this level, wave one, wave two, wave three. And why would you want to be long anything in this market? Because we can analyze with much more clarity which patterns and signals are working well or working bullish, even though the market is trading off hard. We analyze Luckin Coffee, LK, with a bunch of scenarios. Look at the wedge formation. And today it broke out through that wedge. It also is doing kind of a fry pan bottom. It also is moving up off a morning star signal, off the 50, the 34, and the T-line. This shows strong bullish strength even though the markets are trading lower. The big benefit of candlestick analysis is you don't have to be a sophisticated sophisticated technical investor to make profits based upon what the information is being conveyed in patterns that we can recognize much more clearly using candlestick signals. That'll be it. We'll see you in the chat rooms.